Okay, well, good morning, good afternoon, or good evening, depending on your perspective on the world, and welcome to the Trading Coaches Playbook. My name is Brandon Wendell. I'll be your instructor here for a little while, and let me fix this a little bit. Well, that's close as I'm going to get. All right, let me get my chat up here. Good morning, Stephen. Good morning, everyone here. Let's see, I got a small group, but it's a good group. So anyway, today is, good afternoon, Erica. Like I said, Trading Coaches Playbook. Before we get started, to let you know, we're not registered broker dealers or investor advisors, and we look at markets, but from an educational standpoint, I'm not telling you to buy, sell, or hold, or give you personalized advice. There is always risk in the markets. No matter what we do, we can never eliminate the risk. We can only minimize or try to manage the risk, basically. And again, I'm trying to fix my camera here. There we go. It's a little better. It's really weird. I got like this strange background going on. I don't know. The green screen. Let's see if I can fix something here. Whoops. Yeah, exploit V cam. Okay. Not sure why that's going that way. Oh well. Like I said, I'll figure it out later. And oh, now I froze it completely, didn't I? There we go. Now it's coming back, I think. Okay, so I'm back. Anyway, let me fix one more thing. There we go. So I might not get as weird of a funky background there. Okay, we're not subject to any restrictions. I can have a position of security initiate one at any time. Anyway, yada, yada, yada. Legal. So as you can see, we do a lot of stuff here. We do a lot of free online workshops. So make sure you join Rob every Monday for Power Hour from noon to 1 Eastern. He does a lot of good free education for you there. You can pick up some good nuggets. Talking about the markets, the way they move. He does actually a workshop every morning, 8:30 a.m. So you can get a lot of good information there. Actually, I do a workshop too it's usually a Monday afternoon it gets released. It's recorded. It's called the Wendell Effect. So you can actually search on YouTube for that. And yeah, I might as well show you real quick if I can. I can go out to, it's been growing. So I just started doing it about a month ago, a little over a month now, actually. And there it is, Wendell Effect. So if you go there, you'll see 11 days ago, 3 weeks ago, 1 month ago. I'm not sure when the most recent one is. There it is, 4 days ago. So basically what I do is some analysis on the different markets and actually get some of my contact info right there too. Let me just move that forward and see. Let's talk about the chart school. There we go. As you can see, I do weekly market analysis on different markets. So that's absolutely free. All you have to do is do a search, as you saw, for the Wendell Effect on YouTube. And in addition to that, I do some other projects here at the Wealth Builders HQ. One of the ones I do is every Monday, Wednesday, and Thursday from 9 a.m. to 11 a.m. I run a live futures trading room called the E-mini Think Tank, where we actually employ all those ideas and opportunities and trainings that I put out. And basically, you can, let me see if I can find it here. If I go to Wealth Builders HQ. There we go. I just got to log out and log in or something probably real quick. But it's, like I said, lots of good information about the markets and how they work. And I have some recorded information as well as those live sessions. So it's a little bit of both where you can go into self-paced education, learn more about the markets. And then obviously, it's driving me nuts. And then also, like I said, experience the live markets kind of with commentary with me. So today's discussion, let me go back in. I think that was it on the slides. Again, we got the Power Hour on Mondays. We got the Training Coaches Playbook on the weekends, like we have, or Friday, like you're in today. And we got the Market Mornings with Rob Roy every weekday as well. So, and this is actually showing you what I was just talking about right there. The E-mini Think Tank, if you're interested in joining me for that. We charge either quarterly or we do a monthly type of subscription. So if you want to do quarterly, it's great. We can do a 2-week free trial to kind of kick the tires and see what it's all about. And if you want to do monthly, then it's just the monthly fee that you get charged for it. So anyway, what I decided to talk about today was volatility, because if you take a look at the markets as of recent, it doesn't really matter what you're trading. Let me log in here real quick. You're experiencing higher than usual volatility in these markets. And we need to be able to identify when the markets change, because what happens with a lot of traders is they build certain systems and strategies, and they build out those systems and strategies in perhaps a low volatility environment or normal volatility environment. So when the market volatility spikes, they're not really sure what to be doing. And the strategies that worked really well in the past may not work well in the future. You got to basically find strategies that are going to work for the market conditions in which you are operating in. So we go back here. That's weird. Let me do this real quick. So I've got it all tied together on the same. There it is. Perfect. So I'm going to go to a daily chart. And there's a couple different ways of measuring volatility. One, which is probably the easiest, is putting on an indicator for volatility if they have it. So a lot of times you can look for volatility. And you can see we have historic volatility, and you also get sometimes implied volatility on individual securities. There is a big difference between those two, just so you know. So if I go in here and I've got that, let me get rid of this RSI for now. I don't need that. This is what's called historic volatility. Okay. And go into the settings here. I'll widen it out so we can see it a little bit better. There we go. Now, historic volatility is nothing more than price action you're seeing on a chart. That's really all it is. It's historical volatility. What you see in the past. Now, when you're taking a look at implied volatility, that's a little different. Implied volatility is expected price movements in the future. Basically, where you're expecting prices to go. Are they going to be quiet or are they going to be noisy? And, for our purposes, for figuring out trading, we don't necessarily need implied volatility. Implied volatility is calculated based on option pricing. So it's not always going to be accurate. Historic volatility is accurate because it's telling you what's already happened. And you could see that if we just look right here at the S&P futures, and we could do this on any security, honestly, it doesn't matter. But overall, looking back over the past year or so, you can see we are in a very high implied volatility market. What does that mean? It means that we're having very large candles, basically. The price movements are going to be very sharp and very far from where you started off at the beginning of the day. Well, that can be fun if you're a trader, if you're experienced, but it could also be extremely dangerous because that means that you potentially can lose more very, very quickly. We can even look at SPY, which is the ETF that tracks the broad markets. And let me go ahead and clean that up there. Let me go to a weekly chart. And in the weekly chart, you can see we're not at the biggest spike in volatility, but we are much higher than we have been in the past. I'm not sure if I can apply a moving average to this. No, it doesn't look like it. So, but overall, you can just get an idea, like I said, kind of a ballpark, that the volatility is much higher than it has been in the past. That leads to bigger and sharper price movements, which again, if you're on the right side of the market, wonderful. But if you're on the wrong side of the market, not so good. If we change this to Great British Pound, Japanese yen, again, it doesn't matter which security you look at, we can see that volatility for the most part is extremely high recently. Well, this one was higher back in 2020 during COVID, but obviously you see for this year, we've been rising and now we're starting to fall a little bit, but overall we've been in a high volatility environment. And again, this is just one indicator on one chart. I don't know if I had implied, let me see. Implied volatility. And there's a couple of free indicators that people created. Let me see if there's anything here. Implied volatility suite just takes me back to that one, I guess. I can check that out, see what it looks like. I'm not going to dive into it too much. I'm just going to go ahead and do this. There we go. And you can see the same thing. Implied volatility has also been rising. That indicates in the future they're expecting more volatility as well. If you go into stocks, works the same way. You can see that implied volatility, historic volatility, hit a high, and it looks like it's coming down just a little bit. So again, one way of measuring the volatility in a security or how big the movements are likely to be is looking at historic or implied volatility indicators on your charts. And another way, let me see if I have it on this platform. I'm kind of curious. I'll bring up this chart anyway. And I'll just add in, which I use in the courses. Omega Charts is pretty cool. It's a pretty powerful trading platform. It's got a lot of neat tools in it. So I'm going to go ahead and see if I can add in an indicator here to a new pane. And we will look for implied volatility. And I don't see it. Okay. So let's see if they have historic, because they might not have that either. Nope. And I can look down for V for volatility, and there it is. All right. So this is looking at the volatility for the security. Now I'm on a daily chart of this particular security, which doesn't seem to have a whole lot of volatility, but I can actually, you know what? I don't want to mess with this chart because I have it here for a reason. So what I'm going to do is create a new chart. It'll be just as easy. Now let's bring in that KW. That's fine. There we are. So I can manipulate this. And I kind of like that indicator they were showing anyway. So here I am on a daily chart. And again, I will bring in, and there's a link there if you're interested in Omega charts as well. But I can bring back that volatility. Come on, there we go. Add in indicator. There it is. Yeah, we could take a look at something like the NASDAQ futures, or let's do crude oil. That's been pretty volatile lately. And I'll just do a continuous contract, make it easier. There we go. And I'm going to get rid of this. Oops, forgot. I got to do it this way. Different platforms require different keystrokes. That's always fun when I use so many different platforms, trying to remember what I'm supposed to be doing with everything here. So there we go. Now, once again, we can look at crude oil, and volatility is on the rise, as you can see. I happen to be on a daily chart of the continuous contract of crude oil. I'm not sure why. Oh, I don't have enough data going back. Not a big deal. I can fix that real easy. But you see, volatility is increasing. And what should be happening is the size of the candles should be increasing as well. It's usually what will happen. Yeah, let's go back to 200. You can see that in the past, we had much lower volatility than we are currently experiencing. A big difference there. So that changes the way that you trade and the way that you can basically manage your risk. So another way of measuring risk and volatility is also another tool called the average true range. So if I bring in the indicator once again, and in this case, I'm going to bring in the average true range. Should be pretty easy to find that one. It's on the first page. Right there, average true range, add in. Now they use 7. I tend to use 14 periods. There's not a set number that's best, to be honest with you. And I'm going to change the color so I know it's the different one. It's the ATR here. There we go. So average true range usually will also increase when volatility increases. Not always going to do that, but often it will. And you could see that it did increase a little bit, but started dropping off even though volatility was increasing here. So if we take a look at a different security, perhaps the NASDAQ, we'll go to NASDAQ and Q, again, continuous contract. And there it is. And you can see that actually historic volatility started declining, but average true range started increasing. So personally, I actually don't use the volatility indicator. I use the average true range. Average true range is just simply measuring the distance between those and including any gaps that might have occurred from the previous candle. So again, it's measuring volatility because it's measuring how much price movement on average you are getting for each candle, including gaps. So when it comes to comparing the futures, okay, futures only, I haven't really tried this on other securities. People always ask me, okay, well, wait a minute, if volatility is getting high, maybe I need to be, and that's one thing I want to bring up here. So if I go out, I'm going to go to a paint document. There we go. So, And I've done a session on risk management before, and you can probably find it in the archives. I was talking about the YouTube videos. So if you go back again, and I don't have it open right now, but if you go to, again, YouTube, and in this case, if you go to wealthbuildershq.com, or just Wealth Builders HQ, there it is. There's our channel. I believe if you go to the playlists, we have the previous videos from Trading Coach's Playbook. There they are, right there. I mean, you could probably just do a search for this as well, but there's some great videos there. Anyway, if I go to that channel and look for all the different videos, there should be one about tuning the risk radio. Just find it. And here's one, reducing risk and non-directional trading. That's with spreads. That's a little different. A lot of stuff I talk about is how to reduce your risk and manage the risk you're dealing with. If I missed it, you probably just do a search. See if I can find it that way. Nope. Of course, I have to make it difficult. Let me see if I can find it under my name. I think that's it right there. Managing your risk. Coach's Corner. Yeah. So it was before the name change. We're now at the, what is it called? The Trading Coach's Corner, the Trading Coach's Playbook. Anyway, it used to be Coach's Corner. Yeah, this is the one which I can actually copy and put into the chat for you. They talk a little bit more, or I talk a little bit more in detail about some of these strategies. So basically what I was saying is if you are worried about risk, there are some things you can do to combat that. So primarily when it comes to risk management, three main things you can do. Number one is size. You can adjust your size. The smaller size you take, the less risk you have in the particular security you're trading. Another one is going to be, actually I might as well type these out as well because they are apropos and very important for what we're looking at here today. Let me see if I can enlarge this more. Nope. Okay, so size is the type and number of securities traded. So we have minis, we have micros, we have all sorts of things we can trade. Okay. And then when it comes to frequency, that is the number of trades taken or filtered out. The more trades we take, the more risk we run into of taking a bad trade. So if we're very, very selective and take fewer trades, we might have better opportunities in the markets, not risk as much. And number three is duration. Excuse me. And that is the length of holding the position. So basically, the longer you hold on a position, the more risk you're going to incur. You know, the less time you're in the markets, the less risk you have, obviously. So there's a couple other things I wanted to add to this, though, when it comes to dealing with the risk. And it's not just the type and number of securities traded, but we can also look at what securities to trade. So when volatility goes up, we typically want to turn down our exposure to possible. And again, we do that by, if we want to stay with the same securities, we can turn down our time that we're in a trade or the number of trades we take. And if the volatility drops, that where we're seeing that there's a little more safety in the securities, we can turn those back up. So it's very flexible. You don't have to be stuck with only one type of size, a position, and one security to trade with. You got to be fluid with the markets. So as I mentioned, one of the ways of measuring the risk or measuring volatility kind of recap here is using volatility on the charts. And we basically had a couple of opportunities there. One, we had historic volatility, which is showing past price movement, which is okay. Okay, also had implied volatility, which is expected future price movement. That's it. Okay, so let me see. Oops. And then number two, I said we have average true range. And that can give us an idea. The higher ATR, more volatility. And faster, larger price movement. That's pretty much it. Okay. So what we can do then is try to figure out what to trade. Going back to that securities to trade. It depends on what it is that you like to trade. I like to trade futures. That's predominantly what I do, but you can also do options. You can do stocks. Doesn't matter. So one of the things we can look at is comparing them by average true range. So if I go back over to my charts here, and let's say I'm going to stick with, yeah, we got the ATR here. I'm going to go ahead and edit, get rid of volatility for now. There we go. And I'm going to go over to a stock. I'll just go to Apple. Actually, you know what? I can't do it on this. This is a futures account, so I got to go here. That's fine. I'm on Apple. Go in, my indicate. That's the wrong one. There we go. Average true range. Perfect. Rid of this guy. And let's work on that. All right, so we see Apple on a daily chart, a weekly actually. No, I want to go to daily. On the daily chart has an ATR about 5.81. Now remember, all stocks have the same point value and same tick value. Or not tick value, sorry, penny, the movements, smallest movements are all penny. And $1 is 1 point. So they're all the same. So it's pretty easy to compare here. You can see the ATR of Apple is 5.81. Well, let's compare that to something like, well, we can do Tesla. And Tesla has a point movement of 57.93. So which do you think is more risky or more volatile? Well, it's obvious Tesla, right? Because Tesla can move $57, almost $58 just in one day, while Apple's only going to move about $5 a day. So the riskier security is definitely Tesla. You know, we compare that to Berkshire B shares, Berkshire Hathaway, if we wanted to. I think that's the way it shows it. Yep, Berkshire Hathaway B shares, and the average true range is 33 cents. That does not move a whole lot. Is that right? Jeez, maybe that's the wrong security. I don't know. Or if we look at Intel, here you see $1.36 of average true range. So again, you can start looking at securities that have lower average true ranges and filter out the volatility if the overall market starts to increase in volatility. And we can see the overall market either by looking at the index like SPX. And again, look at that, 99.16 for the ATR. You can see how much higher we are than where we have been in the past. That means volatility is extremely high and there's more danger in the markets. You can look at QQQ or NDX. That's the NASDAQ index. There it is, NASDAQ 100. Same thing. We're at 410 points. There's a lot of wild swings there. So we may want to focus on securities that are less volatile when the volatility goes up. How do we know when it's coming back towards normal? Well, depending on the platform, some of these allow you to actually put in, let's see, moving averages on this. And this one doesn't, but some platforms will let you put moving averages. You can see when it comes back down towards the average, or you can really just kind of eyeball it too and see when this starts breaking the overall trend. As of right now, for the volatility here on the NASDAQ, And we started having that trend line kind of accelerated. But you can see there were pockets here where it was very volatile, started bouncing, broke down, and got less volatile. So you can look for changes in volatility like that. Or as I was saying, you possibly look for averages there as well. Let's see, can I do an ATR average? I think I can. So let me see, moving average exponential. If it lets me do this, it'd be kind of cool. Here's weighted. Where's it's under EMA. You know, we'll just do. There's. What the heck is it? No, let's do moving average. There we go. Try that one. And it did. It let me put a moving average right on the indicator. So now I can go and reset that. And based on the chart, oh, there we go. EMA. Perfect. So I can do something like 20-day average right there. And probably thicken that up a little bit too. If it lets me. Style, yes. There we go. So all I've done is just place an average onto the ATR, and you can see when it comes back towards the average, or if you're below average, obviously if you're above average ATR, then you should be very careful because you have more volatility than normal in the security. That leads to higher potential losses and much more risk in the markets. So maybe switch what you're looking at your focus for your trades. Now, since I mentioned I'm primarily a futures trader, there's something I kind of came up with that helps me identify what to trade when it comes to the futures market specifically. So first things first, let me give me a little more room for notes here. There we go. And I'm going to change my color. Type in now. So determining what to trade in futures based on volatility. Okay, so how am I going to do this? Well, what I'm going to do basically is take a look at the daily ATR of the security, which we've already talked about. Now, it's kind of interesting because if you just compare daily ATR to daily ATR of different securities, let's say we're comparing a treasury versus a stock or corn versus crude oil. You can't really compare the two because some of them are going to be naturally higher no matter what. So we need to figure out a better way of comparing volatility between two not really related securities, comparing apples and oranges. And what I came up with was, well, let's take a look at the point values. Point values are assigned to these securities based on volatility as well. Okay, the other things also are like the margin requirements, things like that. So if I take the daily ATR and multiply it by the point value, not the tick value. Okay, you got to remember, I'm talking about point values here. Point values are different than tick values. Tick is for futures is every little movement that the security has. A point is a grouping of ticks. It usually equals 1.0. So anyway, that gives you a number, and I'll call that the vol number, or volatility number. Okay, it's just made up. Okay, it doesn't. You won't find that in print anywhere. I just kind of made that up off the top of my head. And the reason why is I want to see that vol number. Ideally, for newer traders, put that here. They should have a vol number between, it used to be 800 to 1,000, but again, the volatility as a whole has gone higher. So kind of widen the range, but I'll say 800 to 1,200. And that'll give you a good idea of things that you could possibly trade. Now, there is still risk. Okay, you can always lose money, but you may not lose nearly as fast or as vicious as you would by trading something with higher volatility. So let's go ahead and take a look at this and see how it works. Yeah, it might be a good indicator sometime. I don't know. Maybe I'll have to code that or something. I don't know. It's a good idea. You're right. So let me see here. I'm going to go ahead and create. There we are. So I'll start off with NASDAQ since we're there, and I'm going to get rid of that average as well. I just need the ATR. So let's go to the NQ. continuous contract. I'll make it easy. And I'm on a daily chart. Notice I said daily ATR. Right now, the daily ATR for the NASDAQ is 457.67. Well, the point value for the NASDAQ is 20 points. Okay, it's $20, sorry, $20 per point for the NASDAQ. Keep it simple. And therefore, we take 20 bucks times 457.67. That gives us $9,300 of risk. 91, sorry, 53. I don't know where I got the 93. Anyway, so that's kind of high. Basically, I said, as a newer trader, you should be between 800 and 1,000 and 1,200. We're way beyond that. That basically would be if you bought the high and sold the low, how much you would lose on average. Or if you sold the low and bought the high, same thing. You know, how much you would lose, worst case scenario, if you actually absolutely screwed it all up. So let's go to the ES instead and take a look at that one and see what the difference is. So if I go ES and bring in my calculator, I was actually doing some LA wave analysis for people. Anyway, looking at the ES now, we got 107.89. You can see how high the ATR is compared to where it's been in the past. So 107.89 times $50 per point is 53.94. So that is not nearly as volatile as the S&P, or sorry, the NQ. However, it is still pretty volatile, isn't it? So we got 53.94.50. Well, let's try YM. I came up with this many, many years ago, and it's really served me well, to be honest with you. So YM has an ATR of 720. Wow. But the point value is only $5. So we look at 720 times 5, 3,600. That is a little bit more manageable. And then finally, I'll go to the Russell, just compare all of the equity markets and the RTY. See what we're dealing with there. 58.9. And that is also 50 per point. So we got 58.9 times 50, 29.45. So let me show you what I was doing on the other page here, basically comparing all these. So you can see that according to my rules, if you are a newer trader trying to avoid a lot of risk, you should not be trading the full size equity index futures. Well, that's not full size. Technically, those are E-minis. But we can trade the micros perhaps. That's all you have to do is just figure it out. You know, figure out what fits into that window of things that are safer for you to trade, especially as a newer trader. The higher number you go to, the more likely you are to wipe out your account. You see $9,100 if you screw up on the NASDAQ. Meanwhile, the Russell's a lot more forgiving at only $2,900, right? Well, like I said, let me see what those micros are looking like for our comparison charts here. So let's scroll back down here a little bit and bring in M2K. And now we've got 59.1. It's pretty much the same. M2K was 59.1 times 5, though. Okay, so we have a much smaller point value. It's 1/10 the size. So, you notice the ATR wasn't exactly the same. It was close, though. We were at 58.9. Now we're at 59.1. So it really hasn't changed much. But times 5, now we're at $300. So that might be a little bit slow. Okay, so we got 295.5. But it's definitely something that's not going to whipsaw you around as much. Here's another little hint that I want to give you. When it comes to that number that comes out, that volatility number, if you're trying to figure out how much money you're likely to make on the day, not necessarily day trading, because with day trading in and out, you can definitely do more. But overall, if you're swing trading, if there's a strong trend in your favor, count on only on average about 60% of that number going in your favor. What does that mean? Wait, whoa, hold on. What does that mean? Well, basically that means, let's say we're trading the S&P futures right there. With the S&P futures, I said 5394.50. That is that volatility number we came up with based on the average true range times the point value, right? So if you were to have bought the low and sold the high, or shorted the high and bought the low, on average, you could expect to make $5,394. But how many of you are that good that you can always buy the low and sell the high? Anybody? I know I'm not. Sometimes I even do the opposite, right? I sell the high, or sorry, buy the high and sell the low. But yeah, very rarely do I always get to, I don't always get to buy the low and sell the high. I often will catch it from time to time, but not always. So like I said, what I can imagine is that if I'm trading this, I'm probably going to get at least 60% of that in my favor. So out of $5,300, if I'm swing trading and I long on the ES and the trend is up, I could expect perhaps a $3,200 profit in my favor for that day. That can also give you some extra input or insight as to how long you might be into a trade. Think about it. Let me go back to a chart here. And let's say, well, I'll use the Russell Micro since we're there. Okay, the Russell Micro, we had a little area of supply right here. Okay, and let's go back and say, let's see, where do we get to? So let's say we're going down to this target as demand right there. Okay, so we're anticipating if we can get up to 2120, we're going to short targeting 1847. Okay. Well, first of all, let's see how much that is in points. So we got 2120.2. If you want to add that, it's fine. 1847.2. And we're looking at 273 points. Is what we're looking for. I should say potential profit. Because we don't, not necessarily getting that. So the question is, how long should it take for us to get there, right? Well, the average true range, and we could just use the ATR as well. The average true range right now is about 60 points. Remember what I said, roughly 60% of that should move in our favor every day. So I multiply that by 60%, and we're looking at 36 points of potential movement in our favor. So the daily ATR is 60.1. Okay, 60% of that was what? 36. So if we take 273 divided by 36, should take us about 7.5 days to reach our target. That's divided by 36 equals 7.5. So on average, I should expect this to take about 7.5 days to reach the target. It is just an estimation. Could it go faster? Absolutely. Could it be slower? Absolutely. But if we have a strong trend in my favor, I should have expected about 7.5 days to reach the target. And when do we hit our entry? There it is, entry being hit. And that happens to be on March 29th. Let's see when it hits the target. It took longer, didn't it? It works a lot better intraday, but it definitely can work on longer time frames. You can see in March, we took a whole month of April. We were way off on the timing there. So it went much, much slower. And that's because, again, you're not getting green or red candles every single day with no wicks. So on average, when we're moving in our favor, you can see that we should be moving roughly 60% on the days that we move in our favor, but it's not going to do that every day. So it's not the best indication for time. It can help you out a little bit. 7.5 days to move that far was pretty optimistic anyway, I think. I don't think it was going to happen, but anyway, like I was saying before, if I want to compare the risk of different securities, this is a really good way to do it. And all I'm doing is simply taking the daily ATR times the point value, and that vol number is what I'm left with. The vol number between 800 and 1200 is a pretty good idea for something to trade. I'm curious what the micro NASDAQ is. The micro NASDAQ daily chart here again. We get to the end. The average true range is 458. So here, I'll do this. MNQ 458. And it's times $2. It's 916. So that actually fits in the range, doesn't it? Right? Because I'm looking for something between 800 and 1200, and that one actually fits. Some of the other securities that might fit into the range would be the currency markets. So if I go to 6EM 2022, we see the daily average true range 0.0142. Let's take a look. Wait, that's the wrong one. I did GE. What did I do there? What is 6E? I was gonna say that's not going to work. So here we are. We got 0.00978 on the Euro futures. Times 125 for the point value. And look at that. The Euro is pretty good, isn't it? It's on the high end of the range, but it's not that bad. Basically, what I was dealing with there is 6EM22, an average true range of 0.0978. No, 00978. Again, times 125,000, the point value, and that gave us 1224, was it? 1222.5. Okay. Oh, you're right. I did the I do the current ATR. I should have done the current ATR. You're right on that M2K. So let's go back and try it out. And the average true range at that time, it wasn't that much different though. It was 54.4. What's going on out there? Okay. Yeah, so it wouldn't have been that much different. 54.8, we'll call it. Times 0.6, 3288. So yeah, again, it's not that much different. 273 divided by 32. It's about 8.5 days, and you can see it took over 30 days to get to the downside. So that one definitely did not work. And it can work, but it just isn't there. But the main calculation that I find that does work is looking for the volatility and trying to figure out what to trade, where if you take the point value, multiply by the daily ATR, it gives you a pretty good idea of how to compare unrelated securities to find which one is going to give you the best trading opportunities and not kill you. Hang on a second. All right. Sorry, my wife was texting me. That's important. I got to take that. So does that make sense that anyway, the daily ATR versus the point value to give you an idea of what is okay to be trading and what might be a little too volatile to trade? It just gives you kind of a heads up as to what you're looking at. And as I was saying, we can go into different securities even. You can go into crude oil and looking at the daily ATR on crude oil, we're at $4,700 a movement basically. Because again, you take 4.71 times the point value, which is 100, right? And I did that wrong. 4.71 is actually, sorry, times 1,000, not 100. $4,700 of volatility every day. That's really high for people to be able to trade. Even some of the ones that used to be safe, like copper. Copper used to be a pretty good one. And you see the copper is still relatively volatile, okay, but not too bad. And by the way, if you're not familiar with the point values of any security, really easy to find. You go to barchart.com, I'll show you. Copper's 10,000, by the way, but if you're not familiar with it, you just go to barchart.com, go to futures and contract specifications right there. So you just find all the different assets right here. We're looking at metals, high grade copper. I'm sorry, it's 25,000. I said 10,000. I was thinking something else. It's $25,000. Good thing I checked, right? So that's your point value you have to multiply by. So if I go back to my chart, we have an ATR of 0.1. 1081 times 25,000. And that's 2702. So copper used to be easy to trade, but as you can see, over the past couple of years, it's gotten a little bit harder. Look at the difference back here. Back before 2021, we had very low volatility back here. And that was 0.343 back in January 2020. So 0.0343 times 25,000, that was 857. Copper used to be a great security for newer traders. Now it's much more volatile, it could take your money. So you got to be very careful with what you trade and really kind of narrow it down. The nice thing is that the CME has created the micro futures and mini futures. So if we were to look at, I think it's QG for the micro here, or the mini, excuse me. No, that's natural gas. What is the copper one? Oh, let's find out. See if I can find it. They just started that new micro for this one, MHG. There it is. And they have QC for copper mini. So if I just, let's try QC first. There we go. And the daily average true range is 1003. Now we got to make sure we know what the size is for this, because normal size copper is 25,000. So mini copper, I'm not even sure what the size is, and they don't have it here. So I'm gonna have to go to CME group just to verify. It's worth it. It only takes a few minutes to find these things. Let me see. Let's try copper. And it shows futures. Let me see if it shows mini or micros here at all. Find a metals product. You know, the micros there. There's micro copper, there's mini copper right there. There it is. So when I go to the mini copper, should be loading up right now. Contract specs 12,500 pounds. So it's just half the size. That's all. I was wondering if it was. I thought it might have been, but oops. Right here, I go back to my chart, and we have going too far. Too many things open here too. We have 0.103 times 12,500. And that's 1287. So could you trade the micro or e-mini copper? Yeah, it's on the high end of the range, but that's worth trading, and it's not going to bite you because it's a little bit more forgiving. You can also check out the micro if you wanted to, which is MHG, I believe. They just started releasing this, so be careful with the volume. You can see that just started trading, looks like on May 9th. So the volume might not be there. And again, with the average true range, finally got a reading here, 0.0805. And if we were to go back to the copper futures, micro copper, they're releasing new micros. I was looking at it, watching a presentation. They keep releasing new micros, and it's funny, they're actually releasing binary options on the futures market soon. So I don't know if you're familiar with binary options, but basically it's something like this. Will silver be trading above a certain price by 1 o'clock in the afternoon or below? And you pick one of those two, and you put a bet down and you get paid on it if you're right. So they're actually starting that soon. Anyway, this one you can see is only 2,500 pounds, 1/10 the size for the micro. So same calculations we were doing before. Oops, wrong page. So again, going to the right chart, calculator, we're looking at point value times 0.0805. And you can see there might be a little snoozer at $201, but it's going to give you the opportunity to potentially trade without having too much risk. Okay. The volume is only about 1,000 contracts daily. Yeah, typically when I'm looking for something to day trade, I want to see at least 20,000 contracts minimum. You know, you don't want to get into something and not be able to get out. And you can tell when it's light volume if you go down to something like a 5-minute chart and you have intraday gaps like that. You cannot day trade that. It will gain traction. Sure, it's just brand new. Like I said, they're releasing new contracts every single day. I'm not sure if I still have the presentation that I watched yesterday. They gave me the slides. Well, they gave everybody the slides. So I wasn't special. I was just watching this presentation on it. So let me see if I can find it real quick. And see if I can show you what's coming up. Where is it? No, I'm not finding it. Oh, maybe I have a different folder. Nope, not going to find it right now. I'm not going to worry about it. Sorry. I thought I could find it quickly, but I guess I can't unless it's in my downloads file. Downloads. No, it's not there. Darn it. I don't know where I put it. Anyway. But yeah, this will gain traction. This is going to make it just be a matter of time. So again, going back overall here and, you know, different ways of reducing risk, obviously we want to make sure we're trading the right securities. So we can measure the volatility. If we see volatility as a whole is going up, another measure of volatility is the VIX, the volatility index. So if you're looking at the stock market, which really kind of relates to almost everything, but you can actually chart the VIX index. Let's see, that's under futures. Do we have it under indices? There it is, CBOE volatility index. And if I go to a daily chart, this one's not really telling the whole story because we do see that overall volatility is much higher than it has been in the past. However, it's not near our spikes here at 35. You can see we're trading right around 25. Okay, so what this is the implied volatility index for the S&P 500 options. So it gives you an idea of how much implied volatility might be on the index itself. Okay, so there you go. But it doesn't necessarily mean individual securities are going to have that. So, because again, when we looked at the ATR, it was different depending on what it was we were trading. Okay, so that's another way of adjusting the risk. Again, is size, frequency, duration. You can watch that video I mentioned that I put out earlier on risk management. It's one of our training coaches playbook. So all you have to do is search in our YouTube channel, you find it. The other thing is for measuring the risk, if you see the volatility is going up on implied or historic volatility in your charts, or the average true range is also increasing, that's another sign. Another thing that we can do besides choosing what to trade is choosing how we trade things. Something I talked about and multiple times and we'll talk about here as well is what's called a spread trade. One of the things that I like about that style of trading is it really reduces a lot of directional risk. Basically, the higher the volatility is, the more it's our job to make sure that we can handle what it is we're trading. So we want to reduce the risk and make sure we're comfortable. And volatility, the spreads, yeah, the spreads are beautiful. Exactly. I'm glad you like those, Stephen. Yeah. A spread, if you're not familiar, I'm not going to go too much in depth into it, but basically a spread, actually, wait a minute, hold on. I think I have a better way of presenting it here. I did a workshop on it yesterday or 2 days ago, actually. There it is. And future spreads. This has nothing to do with options, by the way. Okay, the efficiency of spreads, they are very efficient. By the way, I run a program as well for wealth builders called Wealth with Spread. So if after hearing a little bit about these spreads, which is something that can definitely help you, if you're interested in learning more of it, Lee just put out the link there. By all means, you can join me there. There's a 2-week free trial, by the way, if you do a quarterly subscription. So getting into spreads, I'm going to kind of skip through some of this. I'm not going to go through all of it, but basically a spread is when you buy a security and you trade a related security against it. So you sell another, you buy one, sell a different one. And basically I'd use an example here of crude oil. You see crude oil is going up. The problem right now, if you want to buy crude oil, well, first of all, we already know the volatility is high, right? If I go back to my crude oil and we look at the daily average true range, we're at $4,700 of price movement there. Yikes, right? There's a lot of fast movements. As a matter of fact, I also want to check something else out here on bar chart. If I go to now currencies futures overview, full list. Energies. Right now, we should be trading the July contract, and we are. We see there's the most volume on that July contract. But that's not the only contract trading. You can see there's August, September, October, and others that are not being shown here. So one of the things that we can do is instead of just simply trading crude oil, we could trade crude oil versus another crude oil contract. So here we have April versus December. Okay, those of you who are futures traders know that the front month contract, in this case, was April at the time. I know that's already passed, but at the time, that was my front month. It's the one with the most volume. You can trade it against other contracts. Those far month or back month contracts have less volume and won't move as fast typically. Take a look. We take a look at that West Texas Intermediate today on this crude oil with the most volume. It is up 56 cents today. But if you take a look at the next one, it only went up 56 cents. Oh, no, they were the same. But look at these back months. Crude oil, October and September only went up 50 cents. So the front month contract, now it's coming down, but at the point when I first looked at this, this was 56, while the other ones were 50. So it had moved up 6 cents higher than the other contracts. That's what happens where you see the front month contract usually moves further and faster than the back months. You can trade that. You buy the front month, short the back month. You profit on one, lose on the other. That's it. So it can be done as a single transaction. In this case, let me go back to crude oil chart. Oops, went the wrong one. And show you something kind of interesting. This is showing the average true range, again, of crude oil only. And it's actually, let's get more specific. CLN 2022. This is the actual contract that we're trading right now, the July contract. And let's see. There we go. I'm going to enlarge this a little bit and scroll down. There we go. So now I am going to be looking at CL, volatility comparisons. So if we look at CLN 22, that's the current market, we're looking at, I think it was 4.52 for the ATR. 454 was close. 454 is the daily ATR. So basically that vol number that I like to use is $4,540, which is well above the 1,200 that we want to get into. So what if though we change this a little bit? Let's say instead of just trading crude oil, we're going to trade crude oil July versus crude oil December. Oh, I typed it in wrong. Now it's correct. Now we're looking at the difference in price between, and you can see it right here, it shows the symbol. I'll zoom in more so we can see it better. Maybe, maybe not. Hold on. There. Crude oil July minus crude oil December. It's literally showing the price difference between those two. And that is right now, that front month is priced 12 points higher than the back month of December. And look at the average true range on that, 1360, right? Basically it's this, CLN 22 minus CLZ 22. And the ATR was 1.36, was it? I forgot now. Yep, 136. Daily ATR. So that vol number is 1360. We just cut down the volatility basically almost to a quarter of it. Okay. Yeah, Stephen, no problem. Talk to you about that. I just hadn't had a chance to respond to you. Anyway, so right here, you can see we cut down the volatility dramatically. And the nice thing about these trades is basically you have more probability of success. Let me show you how and why. Jumping here a little bit. There's a lot more to it, obviously. So first of all, here's the one thing I just mentioned. The margins are a fraction as well. You don't have to pay as much. If you want to trade a spread on the NASDAQ futures, instead of 17,000, it's only $2,500 a margin. Crude oil, it's $9,900 to buy one contract right now and hold overnight. But for the spread, it's only $1,650. So your cost of carry drops dramatically when you trade spreads. That's amazing. Big difference there. Now, rewards are not going to be as high, but percentage rate of return will be higher. Your rate of return goes up, even though dollar-wise you don't make as much because you're not using as much money. Now, the risk is reduced. This is what I mean by that. Typically, when I put in a position, I always put in a stop loss to protect myself. Here you can see I put in a stop, $640 of risk on that stop loss. Well, if I did the same trade as a spread, stop loss can be placed below my zone as well, but the risk is only $120. Remember, we're getting less volatility as well. We went from a volatility of $4,500 to a volatility of only $1,300. So less volatility, less danger in the security, obviously. The probability of success is usually higher as well. This is where I want to get to. When you trade directional trading of a security, you only make money if the prices go in your favor and they go by as much as you expected them to. In a spread, you're trading the price difference between two related securities. That's amazing. So what happens is if you're right and they both go up, you make money because the spread widened. But you can still be profitable if both securities go down as long as the spread still widens. And you can still make money if they go sideways. So now let's just count this. 1, 2, 3, up, down, sideways. You have 3 possibilities for profit versus only 1 when you're directional trading. I think 3 is higher than 1, more probabilities. And it's also something professionals do quite heavily. When you look at what's called the COT or Commitment of Traders reports, you can see that there's a lot of trading going on. In this case, where I was looking at wheat, I believe. Yeah, Chicago wheat. But out of all that trading, over a quarter of it is done in spreads. It's actually very heavily done by these institutions, by these professionals. And you can look it up on any of these securities. There's a lot of professionals trading spreads. So that's kind of neat. So you can trade these and reduce risk, but most importantly, reduce the volatility. And well, sorry, that's risk. That's what I was looking at. I was going to say you can reduce your cost, so you don't have to spend as much in order to get into trades, but more importantly, you reduce your risk. So, I can show you some of the spreads that I've been looking at. There's basically the program, the Wealth with Spreads, the way it works. It's kind of interesting. I'll show you real quick here. Let me go back to my browser. I logged in. If I go to my Wealth with Spreads program, the education is kind of on demand online. So what happens is I have educational videos here, as you can see, that teach you how to trade spreads. So if you log in for the program, again, there's a 2-week free trial if you do a quarterly subscription. So if you like it, you just let it subscribe and you automatically renew. If you don't like it, then you cancel within the 2 weeks and we don't even charge your card. So there's no chargebacks. So I don't want to have to deal with that. So what happens is you get to watch the videos at your own pace and learn how to trade. At any point, if you have questions, you just send me a message and I answer you. Okay, these guys get priority on the messages there. Then what happens is every week I actually put out a video with trade ideas. So not only do I put out the video, but I actually put out a PDF format with my slides and showing you all the trades I was looking at for the week. And again, I'd rather show you live here. So if I go to the live ones, I'm working on the newest ones right now. I'm not going to show you those. But, let's say I go back a week or so here. You can see my trades from the 15th. I found 5 trade ideas. And what I've done is I pointed out what time frame we're trading on, what the security entry would be, the stop, and how much risk you have for one contract. I also go into your targets with how much profit you could stand to make and the margins as well, how much money you have to use to take those trades. So, and then I basically what happens is as the trades are active, you go back, you'll see right here, there's SMS text messages that go out that tell you, hey, it's time to get in. Entry just got triggered, or, what happens with moving stops or adjusting. For instance, today on soybeans versus wheat, I had to do an adjustment. Stop had to be moved to break even, 264.5. because the price moved halfway to my first target. So I basically walk you through all the trades as well as identify the trades. There's also documentation that helps support all those videos that I put out as well. So it's a pretty neat program where if you're want to learn how to trade spreads and reduce your risk and exposure to volatility, that gives you an opportunity to learn it at your own pace and be kind of hand-fed some of the trade ideas that you can practice with. So again, these were some of the trades for this month. This month, almost done. And you can see that I haven't calculated everything out yet, but we ended up with 6 winners, 3 losers, 2 no entries so far. And it's not the best, but normally I want to have a better reward risk ratios, 2 winners, 2 to 1, but I'm right, 2/3 of the time, which is pretty good. And we're profitable for the month. If I go back to last month, let's see how that was. Just showing you the honest stuff. I'm not here to hide anything. I don't care. You can see that last month was okay. It wasn't spectacular, but it was definitely positive. 11 winners, 7 losers. My reward risk ratio again was a little under 2 to 1. That's where I need to get back up on. I'm a little bit off on that. And previous months were better. And if I go to random months, let's see. There it is, wealth with spreads. I'll go to February. As you can see, 15 winners, 1 loser. That was a killer month. That's what, even there, it's only 2 to 1 reward to risk. So for the account size, $25,000 is typically what I calculate. If you were to look to see how much the margins are, obviously you don't necessarily have to take every single trade, but if I added up every single trade, some of them were overlapping, some of them were not. But let's see, if I did every single trade, that would be I6, yeah. So equals sum I6 to I61. So all those, look at that, the margin was only 39,000 if you took every single trade. And that's unusual. You're not going to take every single trade, right? Some of them don't come into play, but that was calculating all the margins for the month. So there you go. Good idea. 40 grand, you could have taken them all, but honestly, it's only going to be about $25,000 to be able to do all this trades. And that's what I have the calculation for as well. When you go back over here and you look, the rate of returns off 25,000. So anyway, that's a little bit more about volatility. Unfortunately, I got to run. It's the end of our time together. So hopefully you got some good insight as to some of the things you could do to help you with adjusting your risk. And there's the notes if you want to take a picture of that. Of course, this video will be up on YouTube as well. If you got any questions, feel free to message me. You can find me on Twitter as well. I write tweets nearly every single day, so you can always contact me there. I'm at TraderBdub. If you have more questions about things we went over here, you can always message support at wealthbuildershq.com. Put that in the chat for you guys. And I want to thank everybody for being here. Have a great holiday weekend. Don't forget it's Memorial Day on Monday. So give thanks for those who made the ultimate sacrifice for our freedoms. So until then, everyone, trade safe, trade well, and you all take care.